Welcome to Iron Financial. This is where we forge stronger portfolios by stress testing companies, looking for cracks and seeing what's really holding them together.
I'm your lead analyst.
And I'm the Market Skeptic. Today, we're taking a deep look at a company that feels like it's from another era, Lamar Advertising. We're talking billboards, giant posters on the side of the highway. In a world completely dominated by algorithms and clicks, can a business like this really be a solid investment? We're about to find out if Lamar is a financial fortress or just a crumbling facade. All right, let's get to work.
So this is the core of it, right? This is the fundamental conflict we have to wrestle with today. Lamar's entire business model is built on physical steel, concrete, and vinyl. It is about as analog as you can get. Now, skeptic, I already know what you're thinking. You bet you do. Billboards? Seriously? In 2026? We live in an age of hyper-targeted digital advertising, programmatic media buys, social media influencers, you name it. Everything is about data trails, click-through rates, and conversion funnels. So why on earth are we spending our time analyzing a company that, at its heart, sells giant signs on the side of the road? It feels like we're trying to figure out the investment thesis for horse-drawn carriages after the Model T rolled out. It seems obsolete.
And that's exactly the tension we're here to hammer out. Is this business model truly an ancient relic, a dinosaur waiting for the meteor? Or is it something else entirely? Could it be an overlooked, incredibly durable, cash-generating machine that the digital-obsessed market just completely misunderstands? We're about to put this entire structure under the forge and see if it holds up to the heat. Let's find out.
Gut feelings and market narratives are one thing, but here at Iron Financial, we build our case on hard data. The numbers don't have an opinion, they just tell a story. So we're going right to the foundation, right to the load-bearing columns of this company. Lamar's full-year results for 2025. It's time to see if this company is built on solid bedrock or just shifting sand.
Okay, let's get the top-line numbers up. Looking at their 2025 performance, net revenues hit about $2.27 billion. That's up 2.7%. You know, it's steady. It's not going to set the world on fire, but it's growth. Then there's this metric, diluted AFFO per share. And don't worry, we're going to break that down in a minute. That's up 3.4%. Again, solid, predictable. But then your eye immediately gets pulled to that middle line, net income. Look at that jump. It went from about $363 million to over $593 million. That is a 63.4% increase. A number like that, that's what gets people's attention.
Let's just put this number front and center, because this is the headline. This is the figure that flashes across trading screens and gets shouted on financial news. A 63.4% surge in profit. Now, what does that number suggest? It suggests something fundamental has changed for the better. It screams massive growth. It suggests this old-school business has somehow discovered a powerful new engine. On the surface, this one data point makes Lamar look like an absolutely impenetrable fortress of profitability.
Whoa, hold on a second. 63% profit growth in a billboard company? That just doesn't pass the sniff test. My alarm bells are ringing off the hook right now. That kind of growth doesn't feel organic. You don't get that from selling a few more ads on the interstate. That smells like financial engineering. It smells like an accounting gimmick or a one-off asset sale. So I have to ask, are we looking at a real fortress here, or did they just slap a fresh coat of paint on a shaky foundation to make it look good for the quarterly report?
You are absolutely right to be skeptical, and that's precisely why we dig deeper than the headlines. That spectacular number, it's almost entirely an illusion. When you inspect the raw materials, you find two major distortions that created this figure. First, they booked a one-time gain of nearly $69 million from selling their stake in a company called Vistar Media. That's not profit from their core business. That's like selling off the furniture to make it look like you had a great month. And second, and this is the more subtle piece of financial engineering, the 2024 number they're comparing against was artificially pushed down by a big one-time asset retirement charge. So what you have is an inflated 2025 number being compared against a deflated 2024 number. The result, a spectacular growth percentage that has almost nothing to do with the actual day-to-day operational health of the business. And this is a perfect textbook example of why net income can be a total facade. It's too easy to manipulate with accounting rules. For a company like Lamar, which is structured as a real estate investment trust, a REIT, the true measure of its strength isn't in accounting profits, it's in cold, hard cash flow. So, for the rest of this analysis, we're throwing net income out the window. We're going to use the right tool for this job. We need to measure the real, recurring cash that this business actually generates. We need to look at adjusted funds from operations, or what we call AFFO.
Okay, analyst, time out. Jargon alert. You just dropped another four-letter acronym on us. Before we go any further, break down AFFO in plain English. What is it, and why is it the right tool for analyzing this company? Fair question. Think of it this way. Net income is like your gross paycheck before taxes and deductions. It looks big, but it's not what you can actually spend. AFFO, on the other hand, is like your take-home pay. It's the actual cash that hits your bank account after you've paid for everything and filtered out all the weird one-time bonuses or deductions. For a company like Lamar with tons of physical assets, net income gets all distorted by non-cash expenses like depreciation. AFFO strips out all that accounting noise. It ignores the one-time gains like that Vistar Media sale, and it gives us the cleanest possible picture of the cash the business is generating from its core operations. It's the true measure of the engine's power.
Exactly. So now that we're using that more honest, more powerful metric, what do we find? We find a diluted AFFO per share of $8.26. That represents a year-over-year increase of 3.4%. Now look, that is not a headline-grabbing 63% jump. It's not exciting, it's not sexy, but it is real. This number reflects the durable, cash-generating power of the actual business. It's slow, it's steady, and it's solid. This is the true foundation that we're here to analyze.
Okay, I'll give you that. The actual cash generation is solid, if a little boring. But generating cash is only half the battle. What are they doing with that money? A steady foundation is completely useless if you're just piling junk on top of it or letting it crumble. Is this cash being reinvested to strengthen the structure for the future, or is it just being burned to patch up the cracks in an aging business model? We need to follow the money.
That is the critical next question, and this slide tells a very interesting story. On the left side, you see free cash flow for 2025 was just under $697 million. Now here's the twist. That number is actually down over 5% from 2024. At first glance, that looks like a crack. But then you have to look to the right. Capital expenditures, that's the money they reinvest back into the business, was almost $181 million, and that number is an increase over 2024. So the reason free cash flow is down is because they are deliberately spending more. They're taking that steady, predictable cash flow and they are plowing it right back into the structure. This isn't a leak in the plumbing, it's a planned renovation. A planned renovation. Huh? You say it's a strategic choice to burn more cash, but I need to be sold on that. Where exactly is this money going? Are they just slopping on a new coat of paint and fixing rusty bolts? Just basic maintenance on a depreciating asset base? Or are they actually building the next floor of the skyscraper? What's the return on this investment? This chart has the answer. Let's break down their capital spending. The lion's share, a full 45%, is being poured into digital billboards. This directly addresses your first challenge about this being a purely analog business. They are actively using the cash generated from their traditional assets to fund their own digital transformation. You can also see the rest of the spending is on maintaining the traditional billboards, on operating equipment and their logo business. They're not just patching holes here. They are actively retrofitting the entire fortress for modern warfare.
So let's see how this all builds out. The foundation seems to be solid cash flow, not just accounting tricks, and we can see they're reinvesting that cash into a digital future. So now it's time to look at the architectural blueprints. What does management themselves plan to build in 2026? Does their official guidance, their own forecast, support this story of steady, forward-looking reinforcement? Here it is. These are the company's own plans, straight from management. They finished 2025 at $8.26 in AFFO per share. For 2026, they're guiding for a range between $8.50 and $8.70. What this shows is a projection of continued, moderate, low single-digit growth. Management is sending a very clear signal to the market. Expect more of the same. Expect slow, steady, predictable cash generation. This is a blueprint for a fortress, not for a glass rocket ship. Look, steady and predictable sound nice and safe, but let's check another page of that blueprint. Earnings per share, or EPS. Lamar's guiding for a range of $5.72 to $5.83 for 2026. The problem is, Wall Street's consensus expectation was $5.91. They missed expectations. That, to me, is a crack in the forecast. It means the pros, the people who model this company for a living, thought the build would be stronger and faster. The company basically had to tell Wall Street to cool its jets. That is not a sign of overwhelming strength or confidence.
And you're absolutely right to point that out. It's a sign of caution. And speaking of cracks, we've come to the part of the analysis where we stress test the very ground this entire fortress is built on, the balance sheet. And when I look at it, I see a potential seismic risk that could shake this whole thing to its core. And that risk has one name: debt, a mountain of it.
Let's not dance around it. Let's put the number up on the screen. As of the end of 2025, Lamar is carrying $3.42 billion in total debt. $3.42 billion. Let that number sink in for a second. That is a massive, crushing weight sitting on this company's foundation. In an economic environment where interest rates can shift on a dime, a debt load that large isn't just a simple risk factor, it is a potential wrecking ball hanging over the entire structure.
And to really understand the immense scale of that debt, you have to compare it to their own skin in the game, their stockholders' equity. That $3.42 billion in debt is sitting on top of just over $1 billion in equity. So let me translate that into simple terms. For every $1 of their own money that's in this business, they have more than $3 of borrowed money piled right on top of it. That is what we call a highly leveraged foundation. Sure, leverage can amplify gains when things are good, but it provides almost zero cushion if cash flows start to stumble. There is very, very little room for error here.
That leverage is, without question, the single biggest structural crack in this entire company. But, and this is a critical but, it doesn't represent an immediate threat of collapse. And the reason for that is this number, $807 million. That's their total liquidity. Think of this as the company's emergency fund. It's the cash they have on hand, plus all the money they can immediately draw from their credit lines. So while that debt mountain is dangerously high, their ability to pay the bills, service that debt, and keep funding those digital renovations is actually quite strong. This liquidity is the critical support beam holding up a very, very heavy roof.
All right, let's recap. We've stress-tested the foundation and found real, durable cash flow, not just accounting tricks. We've found some cracks in their forward guidance and a major structural fissure in their debt load. And we've also identified the crucial liquidity support beams that are holding it all together. It's time. Time to put all these pieces together and issue the official Iron Financial verdict. Is Lamar Advertising a fortress, or is it a facade?
So let's lay out the final blueprint, piece by piece. Step 1, the foundation. At its core, this is a durable, cash-generating business. That modest, low single-digit AFFO growth is real and you can probably count on it. But you absolutely have to account for step 2, the cracks. That headline profit growth that got everyone excited, it was an illusion. Free cash flow is actually declining because of heavy capital spending. And that substantial debt load is a significant, undeniable structural weakness that you cannot ignore. Which brings us to step 3, the support beams. Their strong liquidity position gives them the flexibility and the firepower to manage that debt and, crucially, to continue funding their long-term digital transformation. They have the resources in place to keep building, even with that heavy load.
So here it is, the final Iron Financial verdict. Lamar Advertising is not a high-growth rocket ship, it is a slow-moving freight train. It is built for durability, not for speed. The underlying structure is sound, but it is carrying a very heavy load of debt. This makes it an opportunity, but only for a specific type of investor. Someone who's looking for a steady, cash-generating asset and is willing to accept slow, plodding, predictable growth. It is a trap for anyone who is chasing momentum or looking for explosive returns. You need to know if you're building a fortress or a race car before you even think about adding this to your portfolio.
And that is the final question we'll leave you with today. In a market that is utterly obsessed with speed, with disruption, with finding the next big thing that's going to grow 100-fold, is there still a place for a company that just moves slow and steady? Is there room in your portfolio for a company that's built not to break records, but simply to last? Think about it.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.